exposing the synthetic silver scam. Martin North, John Adams, in the interest of the people. Hello, John.
Hello, sir.
So we're continuing our ramble through silver.
So today I want to actually go into a very interesting aspect of silver, and there's a category of products that are available around the world that I have written about over the last sort of year or so, and I've got some concerns about. When we've talked about mortgages, when we've talked about sort of other things where we thought we had concerns about certain products and the risks that our general audience, our general Australian audience wasn't aware of, we'd try to bring some attention to that. So there is a category of products in the gold and silver market that I know some of our viewers have exposure to, and they definitely don't know the full extent of the risks of these products, because as I've been speaking with my other hat on to a range of Australians about some of these what I call synthetic silver products, what I have found is people are not particularly clear as to, well, what have they invested in, what are the risk profile, what happens when something can go wrong.
Yeah, and just to be clear, John, at one end of the spectrum you've got solid silver, right, which you own and can feel and hold, right?
Yes.
And then you've got essentially a bunch of, let's call them derivatives or flexible products, which effectively are providing access to silver, but not necessarily completely directly.
Exactly.
Just like many other markets, as we've discussed, the one-to-many variables and relationships between underlying and all of the other structures that are across financial markets. So this is not unique to silver, but we're going to focus in particularly on silver because you have the same example of fuzziness as you move further away from the physical.
So I've got three basic definitions here. So first one is physical. When I refer to physical, it means a physical gold or silver product which the investor possesses legal title and ownership and has in their possession. Allocated means a gold or silver product which the investor possesses legal title and ownership, but is stored in a third-party storage facility segregated under a legal identity. And synthetic means an investor has supposed exposure to the benefits of gold and silver, but does not have legal title and ownership.
Right. And we should be clear, John, this is separate from the concept of a futures contract for futures delivery or an options to get a futures contract. This is effectively much more to do with the physical silver and its relationship to the right that you have against it.
Yes. So we're not talking about futures trading.
Yep.
We're talking about products that are offered in the retail market.
Yep.
And these are products offered right around the world.
Yep. Okay. And I wonder how many people, when they actually go buy their ETF or whatever, actually ask the question about how far am I away from the real silver?
Yes. So when I have had conversations about these sort of products, and people have put money in these unallocated, pool allocated, or ETFs, I always ask the question, well, what do you think you own? And generally, people are a little bit unclear that they actually own anything. And so now, one of the reasons why they typically want to buy one of these products is that one is because they are lured in by cheap fees, so transaction costs are much lower. You don't have to pay storage in terms of some cases, and so obviously you don't actually have to handle the gold or silver. So the risk of losing the gold or silver, if you have it in your physical possession, you don't, because someone else is holding that for you. So they're the typical reasons why people can do it. And obviously when it comes to selling or buying, because it's on an online platform, it can be very quick, just a click of a mouse.
And in the case when you don't have physical, right, presumably you've either got some sort of IOU or promissory note or something, or an electronic record somewhere that shows that you've got access to it, right? And that's all you've got.
Correct. Correct.
So John, you've got physical, you've got allocated, you've got synthetic, right? In the case of allocated and synthetic, right, how do we know that there is silver standing behind that transaction? In other words, is it 100% backed in silver?
Those who provide these synthetic products to the market, part of what they say is that that these products are 100% backed. So if you've got $100 million worth in these products, they have $100 million worth of gold or silver standing, that they have it physically in their possession in one form or another. There's also claims of that these holdings are audited and that they are checked, and there are nothing done to these holdings. For example, they're not leased out, that they're not traded on or anything like that. So they're the sort of claims and they're the sort of assurances that like a whole host of entities provide to investors to say, well, how do you trust that this product is real and that you're not going to be screwed over?
Okay, and presumably just like any other asset class and market, there's a lot of different risks, types of risks.
So I just want to, for the audience's sake, is to go through the difference between what I define as market risk versus counterparty risk. So market risk is the risk of losses in positions arising from movements in market prices. Counterparty risk, also known as a default risk or counterparty credit risk, is a risk that a counterparty would not pay as obliged on a bond, derivative, or insurance policy or other contract. And no doubt in your career, Martin, I'm sure you've seen multiple examples of counterparty risk actually coming to fruition.
Well, of course, a lot of the derivatives markets around the world, and can go beyond that, are all about trying to assess risk and trying to manage risk and trying to measure it. And it's all about counterparty risk of various sorts and sizes, right? Because what you want to try and do is to mitigate any downside, but also capitalize on upside, right? And that's what traders do all the time.
If you own a bar of silver like this, you are exposed to market risk because the price of this can go up and it can go down. And obviously, if it goes up, you benefit. If it goes down, then you actually experience losses. But with this, there is no counterparty risk because it's my property and it is in my possession. Now, where counterparty risk comes into fruition in the context of gold and silver is that, so for example, if I had that, now there's two types of counterparty risk. Now, with a bar of silver that I own, if I was to store it here at your facility, that's a form of counterparty risk because even though it's my legal title, if I ever want to retrieve it, there's a trust that in your vault you're going to sort of produce it and it's all going to be fine. But then when it comes to these synthetic products, is the counterparty risk is that one, if I wanted my theoretical share of this pile of gold or silver, if I wanted to convert it, that they actually have the gold or silver to convert when I want it. And so timing is obviously critical. And then obviously the other point is that if I ever wanted to cash out my position, because I don't actually technically legally own anything of a tangible nature, that the counterparty has sufficient funds to provide the money, or so that I can get my money and I have to say, so you get your money at the price in which the market prevails. So for example, if you buy something at say $5 and the price was to escalate to $100, well, obviously you would expect that if you cash out your synthetic position, you'd be paid out at the $100 price.
And I guess the counterparty risk has to take account of the possibility of it's not just you wanting to, for example, convert to silver. It could be that everybody on the same day, theoretically, might want to convert to silver.
Yes, and look, I'm glad you mentioned that, Martin, because it's no different from a bank.
Yeah.
So I mean, when you think about the banking system, we have a fractional reserve banking system. So so the bank will have a certain number of assets and they'll have deposits on hand of a certain percentage. So while there is a small amount of deposits being asked for, the banking system works fine. If everyone was to walk into the bank today and say, I want my money, well, then you have a bank run and they don't have all the money there. And so that's when you have capital controls and they say, well, you can't have your money. So again, now, the proponents of these products say it's 100% backed, and if it's 100% backed, there should be no run. And even if everyone was to ask for their metal today, they should be able to get it in theory. Now, if there was some reason that it wasn't 100% backed, and you did ask for it, and there was a lot of pressure for it, well then obviously those sort of elements do get exposed. And while I'm not aware of any Australian examples of that, I mean there definitely have been international examples of claims of backing and then when you stand for delivery, those things actually haven't come to fruition.
Well, how do you know if you're an investor in one of these things and it says 100% backed, right? You take their word for it, but how do you validate it?
Well, so those who provide these products, their assurance to the market is that the backing is audited by someone independent, and the auditor's opinion, that is what you rely on to say,
Right.
I'm confident. Now, if you are involved in this market, gold or silver, if you have one of these products, or if you are looking at various options, it's definitely worth your time to actually understand the differences between owning something that you have legal title to versus something that is a synthetic product, and what are the risks and what are the insurances, and obviously everyone has to make those sort of assessments.
Yeah, and just John, to drive the point home, I know people who trade shares and use synthetic shares, right? And they have exactly the same exposures, and they don't get it. They don't understand the difference between the underlying and some of these synthetic things. So it's really, really important for people to really understand what they're getting into.